U.S. stocks rallied to their highest levels in 4 years after Europe's central bank announced a sweeping plan to solve the region's debt crisis. 5 weeks after pledging to do whatever it takes to preserve the euro, ECB President Mario Draghi delivered on his promise by launching a program to buy unlimited quantities of eurozone bonds. Investors around the globe reacted to the concrete move with broad-based buying of stocks. Here on Wall Street, all the major averages rose about 2%. The Dow skyrocketed 245 points, the Nasdaq surged 66, and the S&P 500 jumped almost 29 points. Mario Draghi is finally getting his way. The head of Europe's central bank has been battling the region's power players on exactly how to save Europe. Draghi's plan for unlimited bond buys is aimed at lowering borrowing costs for debt-laden countries like Spain and Portugal.
Under appropriate conditions, we will have a fully effective backstop to avoid destructive scenarios with potentially severe challenges for price stability in the euro area.
But those bond purchases come with strict conditions, and the ECB will only help those countries that follow the rules. To make his proposal more palatable, Draghi agreed to waive the central bank's senior creditor status on any bonds it buys. That means private creditors would be treated equally in case of default. Among ECB members, only Germany's Bundesbank objected to Draghi's plan. In a statement today, the Bundesbank said its president regards the purchases as tantamount to financing governments by printing banknotes. Nicola says the Draghi plan buys time, but it still doesn't solve Europe's growth problem. He's chief market strategist at Convergex Group. So, Nick, what do you think of this? Does the program make sense? Is it a good step?
It is a very solid step, and I think you saw the markets respond to that today. It's open-ended, it goes out through 3 years, and it does buy the euro quite a bit of time to help some of the countries that are really on the periphery and still quite troubled begin to address their longer-term structural problems.
But it doesn't solve all the problems. I mean, it does pump in a lot of money into these struggling economies, but it doesn't deal with all the spending issues and getting the debt down, and it doesn't deal with how to get these economies growing again, right?
That's absolutely true. All it does is buy some time, but quite a bit of time. And I think the response you saw from markets today was more a sense of relief that we're going to have a chance to have that time versus any of the nearer term deadlines that were being talked about, or a lot of the problems that you're seeing in the debt markets with periphery countries like Portugal and Spain and Italy paying higher and higher borrowing costs. So you're right, it buys time, but it doesn't really resolve anything.
So how will we know if it's really working or not? Let's say in 2, 3, 4 years, what kind of shape will countries like Spain or Italy or Portugal be in?
Well, the consensus of investors that we speak to about the state of the European economy basically agree that most of the European economy region is going to be in recession for the back half of this year and going into next year. Unemployment rates are still very high. Economic growth is still quite sluggish. The best case scenario is that you see these economies begin to grow again in the latter half of 2013 and begin to grow more substantially in 2014, but no one's expecting anything more than 2 or 3% GDP growth as these economies begin to recover.
Speaking of growth here in the U.S., everybody's waiting for this jobs report that's coming out tomorrow. The consensus estimate is that American businesses added something like 130,000 new jobs. What are you expecting?
We're expecting a little bit better. We're expecting something closer to 150,000 jobs added and an unemployment rate that basically is 8.2 to 8.3%, pretty much unchanged from the past few months that we've seen.
So if the number comes out, as you're saying, combined with what we heard from Europe today, what does Ben Bernanke and the Fed do? Do they need to add more stimulus to the economy?
Well, I'll tell you, the investors that we speak to are pretty well convinced that the Federal Reserve, Ben Bernanke, and the FOMC will have to do something incremental next week. The meeting ends on Thursday, and there is a press conference with Ben Bernanke speaking to the press at 2:15 on Thursday. So we'll hear a lot more then, but the consensus is very much that the Fed will continue to act and put some more stimulus into the economy on Thursday.
And what about the markets? Real quick question. We have 30 seconds left. Do you think individual investors are ready now to buy into this rally?
You know, it's been very, very tough. Investors have been really buffeted by a lot of volatility the last couple of years, and even as you rightly know, we're at multi-year highs. Investors are still very, very cautious on this equity market. They're still worried about the economy. They're worried about the election, the fiscal cliff. There are still many issues investors are focused on and worried about. So we'll see people come back in, but very slowly.
Okay, thanks a lot, Nick. Good conversation. Nick Colas, Chief Market Strategist at Convergex Group.